Hi everybody, Neil Shaw again from the law firm of Shaw & Associates PC, a law firm dedicated to protecting your family, your business, and your legacy. I was at an event a couple of weeks ago when I heard a couple of financial advisors getting into a dispute as to whether or not life insurance proceeds are taxable. And they saw me sort of squirming in the corner, but they recognized me as an estate planning attorney, so they called me over and asked me to settle the dispute. And here's what I told them. Life insurance proceeds are free of income tax, and most people usually stop there, and they go ahead and say life insurance is tax-free. However, when somebody owns a life insurance policy, when they pass away, that life insurance death benefit is taxed as part of their estate. I'll use New Jersey as an example. In New Jersey, if somebody has a $1 million death benefit life insurance policy, and I have it so that my kids receive that death benefit, well, if it exceeds the exemption in New Jersey, which is $675,000, then yes, it's part of my taxable estate. So the truth of the matter is, when somebody dies and they own a life insurance policy, the death benefit is included as part of their estate. And if it's over a certain amount, and if it's going to anybody other than the spouse, then yes, there's going to be an estate tax. There's other problems with life insurance to have owned in your individual name as well. What if I have my policy being paid to my minor children? Well, in that case, what happens is the minute they turn 18, they fill out some paperwork at the surrogates court and they get access to everything. And I always tell my clients, look, when I was 18, if I had a couple of $100,000 or a couple of million in the bank, well, let's just say I'd be a different person today. The other factor is, what if the kids are just fine? What if the person who's receiving the money is old enough, however, they're in a failed marriage, or they run into some debt problems, or they have other financial woes? Well, in essence, the money that was paid out in the death benefit is all available to creditors. So we brand these people sort of creditors and predators. And if the insurance money is paid out directly to somebody who's already got a poor financial situation, well, there's a good chance that they can get attacked by those predators and creditors. And then finally, what if somebody's receiving special needs assistance, meaning they're getting government benefits and they're needs-based? Well, now all of a sudden they get this lump sum cash from an insurance death benefit, and lo and behold, they may not be eligible for their benefits anymore. So what's the solution to this? Well, generally for our clients, what we'll suggest is that when you have life insurance policies beyond a certain value, even if it's not a huge value, but it's being paid to somebody who's not really ready for all that much money, have the policy owned and the proceeds payable to a life insurance trust. Now, what that exactly is probably a little beyond the scope of this conversation, or this video, I should say. But suffice it to say, the life insurance trust is essentially a trust which is designed to own your life insurance, and when somebody passes away, to have the life insurance proceeds paid into the trust itself. It's a great vehicle because in that case, if it's in the trust, it's protected from predators and creditors. And lastly, because it was transferred to trust before death, it's not part of the taxable estate. Thanks for listening. I'm Neil Shaw of Shaw & Associates. Look forward to seeing you soon.